Continuing our first session, we have the second paper, which is Do Non-Banks Need Access to the Lender of Last Resort? Evidence from Fund Runs. And it's going to be presented by Marie Hoerova from ECB.
Thank you so much. I would like to start by thanking Amit and Roche for putting the paper on the program. This is joint work with Johannes Breckenfelder, also my colleague from the ECB, and I should stress that the views expressed are solely our own. Well, we already heard in the President's speech, and also Nicola highlighted how important non-banks have become. In the euro area, they account for close to 60% of financial sector assets by now, and they also became a significant source of financing for corporates. As the importance of non-banks grew, so did the concerns that risks in non-banks can adversely affect financial stability and monetary policy transmission. And I think it's fair to say that what happened in March 2020 led some credence to these concerns, whereby we saw an unprecedented liquidity crisis in the investment fund sector, and I will illustrate on the next two slides the extent of this crisis. And whenever there is a liquidity crisis somewhere in the financial sector, inevitably the question is asked, do non-banks need access to the lender of last resort? Should there be some kind of access? And with this work, we will try to provide an input into this debate. So what happened in March 2020 with investment funds? Well, there were runs on euro area mutual funds, and this chart here illustrates that. It shows you aggregate net fund flows in percent between February and April of 2020. And it's inflows minus outflows. So whenever you see large negative bars, this is outflows, net outflows from the funds. And this is actually investment grade bond mutual funds. And that's exactly what we saw in March 2020, large negative bars. The peak outflows reached about 0.5% of total net assets in this sector. And there are also some vertical bars in this chart that indicate central bank interventions that we shall study in this work. These outflows were unprecedented in scale, and they largely affected bond funds. Just to give you an idea of magnitudes, about 150 billion euros were withdrawn from euro area bond mutual funds in the course of just a few weeks. This was not confined to the euro area, these exceptionally large outflows. We also saw them in US bond mutual funds, particularly corporate bond mutual funds, as documented by Falato et al. And very importantly, this crisis was not really just confined to this sector, because what happened is as funds faced runs, they had to fire sell assets, and that put strains on broader financial markets. Again, as documented by a number of papers for the US, but also in the euro area, investment funds were the largest net sellers of assets in March 2020, selling more than 200 billion worth of assets, again, in the course of just a few weeks. What we also document in the paper is that funds face the dry up in repo markets. So when a fund needs liquidity, it can sell the assets, or it can repo those assets to get liquidity quickly. And what we document is that it became increasingly difficult for funds to do so. Here is a chart that illustrates that. It shows you new bank lending to funds in the repo market in billions of euros, again, between February and April of 2020. And banks are really dealers in this market. And what you see is that bank cash lending to funds dropped by 50% between February and March 2020, from 30 billion a day to 15 billion a day. And again, there are some vertical bars in this chart that shows central bank interventions that we shall study in this work. So this dry up in repo markets further aggravated potentially the liquidity strain that this sector faced. So what do we want to do in this paper? We want to use this crisis as a laboratory to assess the impact of two ECB interventions. We will study what I call direct interventions, asset purchases, and the way we think they may be helpful to funds faced with a liquidity crisis is that they may attenuate fire sales, directly support market prices of assets held by funds, and thereby stabilize outflows. We will also look at indirect interventions, meaning the bread and butter of central banking, providing liquidity to banks. And here we will ask, do banks channel this liquidity that they obtain from the central bank to funds? We will be looking at the repo market. Again, the idea is it might reduce fire sale pressures. Why do we think this is an interesting laboratory? Well, first of all, the trigger was exogenous, pandemic-induced, that led to aggregate dash for cash in the financial system. Second, we think the euro area setting is particularly interesting because the ECB didn't set up any new facilities to deal with this crisis. It basically used the existing tools. And another advantage of looking at the euro area, among many, is that we have very granular data on funds, on banks, including the lender of last resort access, and also on bank fund trading relationships in the repo market. And much of the data we will use is daily, which is going to be very important because, as you will see, there were several interventions in quick succession. So it's nice to have daily data to have some hope of discerning what was going on and what was the impact. So what I would like to do is I would like to tell you what we find for direct interventions, asset purchases, and their impact on funds. Then I will talk about indirect interventions and their impact on funds. And I will conclude with some thoughts on policy implications. So let me start with asset purchases. We're going to look at the impact of purchases on fund performance and flows. And we're going to zoom in on the new program that the ECB announced. It's called the Pandemic Emergency Purchase Program, or PEP for short. It was announced on March 18th, 2020, in the evening after the markets closed, including in the US. And it started being implemented, meaning the first purchases took place as of March 26, 2020. In this part of the analysis, we will focus on bond mutual funds that invest in investment-grade securities and hold a non-zero share of euro area securities in their portfolio. Why this particular set of funds? Well, because we want to have a relatively homogeneous set of funds ex ante before the interventions took place. So we want to look actually at investment-grade funds. And we also want to look at funds that have a potential to be affected by what the ECB does, meaning they have some exposure to the euro area. And then we're going to do something rather straightforward. We're going to compare funds with higher shares of PEP eligible assets ex ante. We're going to look at their portfolio holdings in January 2020. And we're going to compare them with funds that have lower shares of assets that are eligible for ECB purchases. You might be wondering what the difference is related to, for example, to holdings of bonds issued by US issuers or by euro area banks, who are very large corporate bond issuers in the euro area, but neither of these type of securities are eligible for ECB purchases. So what was the PEP impact first on fund performance? And this is really a chart that tells the story, I think, very nicely. It shows you fund market value change in percent between February and May of 2020. The performance is normalized to 0 at the beginning of February of 2020, and then it's traced over time. And it is plotted for two groups of funds. In solid blue are the funds that have higher eligible holdings, ex ante, for ECB purchases. And in dotted red are the funds that have lower eligible holdings, ex ante. What is interesting to notice is that the performance of these two groups of funds is remarkably similar all the way until the ECB intervention on March 18, including this precipitous decline in performance in early March. But what happens on March 18, in fact, the vertical bar here is on March 19, which is when the markets open after the PEP announcement, you see that the performance of the group of funds in the solid blue line jumps immediately and continues trending upwards, whereas the performance of the group of funds in the red dotted line continues to decline and only recovers gradually later on, and I will talk actually about what caused that recovery or what helped that recovery. Again, this is just data for now. We put this data into a diff and diff setup. And what we find is that after PEP announcement, a gap between this higher and lower eligible groups develops. And this gap is equal to 3.6 percentage points in the week in which PEP was announced. It is 2.6 percentage points in the first implementation week, declines to 2.1 percentage points in the second implementation week, and thereafter becomes insignificant. Okay? So on announcement, we find very strong effects. And this is actually an important result because we know from prior literature that bad performance can trigger outflows. So presumably, if PEP managed to put a floor and improve fund performance, it might have also helped with runs the funds face. So this is what we test next. Here is our results, diff and diff, in the format of a table. So again, what we're interested in is the differential between the group of funds that have more PEP-eligible assets compared to the group of funds that have lower PEP-eligible assets, and this is the differential that is here in this table. First thing to note is before the intervention, there is no difference between these two groups of funds. But then, in the week of PEP announcement, we see that the differential develops. Just to give you a sense of magnitudes, the funds that had lower PEP-eligible assets still face daily outflows of minus 0.5% of their TNA, total net assets. But the funds that have more PEP-eligible assets had lower outflows by 0.323 percentage points. And that means, in relative terms, that net flows in funds with higher eligible holdings were actually up by 62% after PEP announcement. We find that by the end of March, runs pretty much stopped and flows largely stabilized in both groups. So we no longer find statistically significant differential after that PEP announcement week. We do a few additional analyses. Let me share two analyses with you. First of all, we find very strong announcement effects, and the question is why. So what we do here, we investigate the role of PEP flexibility. It's the feature of PEP that allowed ECB to temporarily tilt its asset purchases towards certain issuers. What we do here is we split funds into more versus less exposed to the most indebted euro area countries within the more eligible group. And indeed, we find a performance differential of 2.6 percentage points in the announcement week, which means that those funds that were more exposed to the more indebted euro area countries benefited even more from the PEP announcement. We also control for US Fed interventions, and there were two large interventions on March 23rd and on April 9th, 2020. What we do here, we're going to double sort funds on both their PEP and on their Fed eligibility. And we are going to also include daily dummies to zoom in more closely on the impact of interventions day by day. So here are the results, and I'm showing you the performance differential in percentage points. First, for the group of funds that have ex-ante more PEP-eligible assets. And what you see here is upon PEP announcement, which is the first vertical bar, PEP announcement on March 18th, the performance of funds that have more PEP-eligible assets jumps upon announcement by more than 1 percentage point. It continues trending up. It remains statistically significantly higher compared to the other funds, decreases after about 2 weeks, and is eliminated, this positive differential, with the second US intervention on April 9, which was shown in the literature to be very impactful. Okay? What did it do, that interventions? It lifted the performance of funds that had more Fed-eligible assets, and that eliminated the differential. What is also interesting is to look at the group of funds that have both a lot of ECB and a lot of Fed-eligible assets, and this is what this chart shows on the right. Again, it's performance differential in percentage points. What you see again, with the PEP announcement, performance jumps upon announcement, stays positive, and what the US Fed second response on April 9 does is that it keeps going, this differential, it remains positive for some weeks to come. So this is for the funds that were lucky enough to have both a lot of PEP and Fed-eligible assets. In sum, even when we control for Fed interventions, we find very strong PEP announcement effects on fund performance, but also on fund flows. Okay, let me go to the indirect interventions, so central bank liquidity provision to banks. And what we will be interested in is to look how that central bank liquidity provision to banks translated or not into bank repo lending to funds. What we are going to zoom in on here is new long-term refinancing operations, LTROs for short. We always have lots of acronyms in central banks. And these particular LTROs were called bridge LTROs. They were announced on March 12, 2020, were conducted weekly, and all matured on June 24, 2020. Why this magic date? Because there was already a pre-planned large liquidity providing operation on June 24, and these operations were meant to bridge the time until that large operation. What we will do here, we will focus on relationship an investment fund had with banks prior to the crisis. Bank fund relationships in the repo market are sticky. They don't really change over time, we find. And we will focus on funds that have at least 2 such bank relationships so that we can control for fund-specific effects using Quadjamir methodology. Now, we need some cross-sectional variation of banks. We want to test kind of the bank lending channel. So we are going to compare bank repo lending across banks with higher versus lower exposure to the pandemic-induced liquidity crisis ex ante. We're going to explore 2 different cross-sectional splits, one on commercial paper rollover and one on excess reserves banks hold. So let me tell you a little bit more about these 2 splits. Here is a chart that illustrates why we think it's interesting to look at commercial paper market. And what's interesting is that by mid-March, this market basically came to a standstill. So this chart shows you the issuance of bank commercial paper in billions of euros, and you see by mid-March, it was basically impossible to issue any commercial paper. And so what do? We will split banks on those that had commercial paper maturing in March 2020 versus those that didn't. And this will give us a measure of bank funding liquidity needs, own funding liquidity needs. We will explore also a second split on excess reserves. So we will take excess reserves bank held as a ratio to their total assets, ex ante, as of January 2020. And this will give us a measure of readily available liquidity banks had. And then armed with these two splits, we are going to test how bank repo lending to investment funds changed. First, following the announcement of the bridge LTRO compared to the previous week. And second, following the settlement of the first bridge LTRO. What does it mean, settlement? It means that those banks that ask for central bank liquidity actually receive that liquidity on their balance sheets. Okay? And again, we're going to compare to the previous week. We will stop after that. The reason being is that many other interventions happened after that first bridge LTRO settlement, so it becomes very hard to isolate different effects. But also because this first bridge LTRO was actually the largest operation of its sort, both in terms of the number of banks that came and in terms of the allotted amount. So it's an interesting operation to study. What is our underlying hypothesis? Banks that were more exposed to March 2020 liquidity crisis themselves should be relatively more affected by the central bank liquidity provision, and we will trace whether they pass on that central bank liquidity to funds in the repo market. First question is what happened in the announcement week of bridge LTROs, and the answer is nothing happened. Okay, we don't see any differential impact of the announcement, and our interpretation is when the problem is liquidity, just announcing future liquidity provision is not going to make a difference in terms of bank repo lending to funds. Perhaps the actual provision of liquidity might make a difference, and this is what we are looking at next. Here are our results for what happens in the week of the settlement of the first bridge LTRO operation. It's also when the PEP was announced. And the variable of interest is this exposure dummy. Is it the bank that is more exposed to the March 2020 liquidity crisis, either because it has commercial paper coming to maturity and has difficulties rolling it over, or because it has lower excess reserve holdings? We have these two splits, commercial paper split, excess reserve split, and we measure repo activity in two ways, by the change in transaction volumes or by the change in the amounts outstanding, so flows and stocks, if you will. But no matter what we do and no matter what split we use, the result is always the same. More exposed banks lend more in the week when the first bridge LTRO was settled. And so both the transaction volumes and repo amounts outstanding are going up. To give you a sense of magnitude, they go up for this more exposed group of banks by about 60% compared to the previous week. So it's actually quite a large increase. Okay, banks lend more, but does it have any impact on funds faced with runs? What we do here, we compare outcomes across funds with and without prior relationship with the bank that actually got liquidity in the first bridge LTRO. We think of it as with and without indirect lender of last resort access, if you will. What do we find? We find that after the first bridge LTRO, funds with that ex-ante LTRO bank relationship had higher repo borrowing from the banks that obtained LTRO liquidity, and had also higher performance and flows even after we control for PEP eligibility, for the share of PEP eligible assets they hold. Now, I want to caution here that, at least from the data we are looking at, it doesn't seem to us that repos is really a panacea for funds in two ways. First of all, repos are not widely used by funds. We estimate that only about 5% of bond funds in the euro area actually use repos. Second aspect is that repos are actually not easily scalable for funds because of the regulatory leverage limits they face. They can only lever up in Europe up to 10% of their net asset value. So if they face large outflows, which many of our funds did, it's going to be difficult for them to cover those outflows by repo borrowing because they will hit that limit. By contrast, the direct interventions, asset purchases, actually do not add any leverage. So they have that particular advantage in a crisis. So let me conclude with some policy implications. Do non-banks need access to the lender of last resort? Should funds become eligible central bank counterparties? Should there be new dedicated credit facility, perhaps just in crisis times? Well, first, let me say that there are lots of challenges of granting funds and non-banks more generally access to the lender of last resort. There are operational challenges. There are many thousands of funds just in the euro area. There are also those regulatory limits on fund leverage. It's going to also make it difficult for funds to borrow from the central bank. And there are, of course, potential additional risks that come with the access to the lender of last resort. What this paper showed is that applying the existing toolkit during March 2020 was actually helpful. Asset purchases, let's think of it as market make-off last resort interventions, were very effective. Fund performance improved upon announcement, and outflows stabilized very quickly. Central bank liquidity provision to banks was also helpful. It did support bank repo lending to funds. So we view this as a potentially useful input into a cost-benefit analysis of granting access to non-banks to the lender of last resort. Thank you so much.
Thank you, Marie. We have two discussants. Our first discussant is Jean-Charles Rochet from Toulouse School of Economics.
Thank you very much. It's a privilege being here to discuss this very interesting paper by Marie and Johannes. Let me go into the motivation first. So, as Marie explained very clearly, central banks are concerned that runs on the mutual funds could destabilize bond markets, and this actually happened in March 2020. And the Fed reacted by creating new facilities, whereas the ECB decided to use traditional tools, particularly the LTROs, and also expanding large-scale asset purchases. And the idea is that the banks that receive liquidity assistance from the central banks would rechannel the funds, the liquidity to the funds. It's kind of a trickle-down theory of liquidity. And the main objective of this paper is to test this assumption. So what the paper does is basically to study the liquidity crisis of March 2020 and the reaction by the ECB. And indeed, there was a massive outflow from bond mutual funds threatening the proper functioning of bond markets, and the ECB reacted in two ways. One is expanding its asset purchases program, and actually there is an unfortunate typo. It's not PEEP, but PEP, so it's involuntary. But the other tool was to provide additional liquidity assistance to banks through the bridge LTROs. So the main result is that indeed the funds with higher proportions of security eligible to PEP had higher returns and lower outflows. And the banks that borrow from in LTRO passed on this liquidity to the funds. So it shows that the ECB managed to support indirectly the funds that were hit by runs simply by providing additional liquidity to banks, so that the banks could sort of recycle this liquidity to funds. And so this suggests that there is no need to make lender of last resort accessible to non-banks. I will come back to this, but my main objective here in my discussion is not so much to discuss the empirical strategy, but more to discuss the foundation, the justification, and the modalities of lender of last resort operation in the 21st century. So let me, I mean, you already know that, but it's important to start with the old Beige-Hot doctrine of the lender of last resort that was based on the observation that illiquidity problems, such as runs, can force solvent banks into bankruptcy, which imposes obviously a big stress on the financial system. And this stress can be avoided if the central bank is ready to provide emergency liquidity assistance. Basically, the Beige-Hot doctrine has 3 points. First of all, you need adequate collateralization to protect the central bank for credit risk, and second, to charge a high interest rate. But the question is, as Raghu pointed out this morning, it's not clear how far you can go on that, but it's an instrument to limit more hazard. And then there is this notion of potentially unlimited intervention to reassure investors. So many central banks have adopted this doctrine, but sometimes it was twisted to bail out insolvent banks, in increasing moral hazard. And now, and I'm very much in line with what Nicolas presented this morning about the transformation view. I really believe that we are seeing a transformation of financial systems, and therefore maybe the way we react, the way we regulate financial institutions and the way the central bank intervene should also be transformed. And in particular, I believe that they should be the analogous to this doctrine. We have to develop a doctrine for a market maker of last resort. If we want really the central bank to act as a market maker of last resort, what does it mean? When and how should the central bank intervene? And more importantly, why? What is the objective? Is it really correcting market imperfections? Well, there are so many market imperfections that it would be really endless. So I really believe we should develop an analogous to this doctrine for the market maker of last resort. And it's a completely different object. We are not trying to rescue individual institutions. We are trying to protect markets. And that's a completely different setup. So the first thing of course, I understand that I don't want to go into that, but I believe that in the back, this aspect should be discussed. The other aspect is notion of enhanced lender of last resort. The wider set of collateral eligible for lending to banks, outright asset purchases, including private paper, and also the US reaction, which was to create a new facility. Every time there is a problem in the US, they create a new facility to deal with these problems. And I believe that the two views, the US and the European view, have different implications for regulation. I believe that regulation and the safety net is a kind of, quid pro quo, whereby banks accept to be regulated in exchange for access to the lender of last resort. So I believe that if non-banks have also access to a lender of last resort, in the US view, it would be fair to ask additional regulation on those non-banks. But if you adopt the European view, which is that we don't need any specific facility, but it's instead the role of the banks to support the funds, then we need maybe to investigate in more detail what the banks are doing and maybe regulate more the banks' funding of non-banks. And in fact, you have exactly the same debate in the payment industry. In the payment industry, we have non-banks entering the markets, the so-called payment service providers. And if you want to have access to the payment system, you have to fulfill a certain number of regulation, which is relatively light. But those payment service providers are regulated in some way, are monitored by some institution, not necessarily the central bank, by the way. And so I believe we should do the same for this liquidity provision. In the payments industry, if a payment service provider wants to provide credit, then it has to become a bank. And so maybe the idea is that if non-banks want to expand its domain of activities, maybe it should also be regulated as a bank. So this is one of the points I would like to accept. The other thing is it's not entirely clear what is the main objective. That is it ensuring financial stability? Is it safeguarding monetary policy transmission? Or is it supporting credit to the real economy? And of course, the three objectives are not completely distinct. So I believe that the paper could discuss, or should discuss, the distinction between interventions that are ad hoc interventions after specific events, and the word last resort alludes to that. You want to do that, it's exceptional circumstances, when there is a market freeze, when there is a run on a mutual fund, then there is some kind of intervention, but then this should be also clear what the purpose of this intervention is and what conditions, what instruments should be used. But there is a different thing, which is the recurrent intervention motivated by enhancing monetary policy interventions. And I believe that this is an important issue, and the paper is really interesting because it shows that maybe the European approach works well, that you don't need to create these new facilities to support non-banking financial institution, because I believe the US regulatory landscape is already quite complex, so you don't want to add other layers of complexity. But it's important to clarify the justification for the tendency of central banks to intervene more and more in financial markets. What is it that you want to do and why? And in particular, there is always this trade-off between financial stability and moral hazard, but how do you do that concretely? What instruments are you allowed to do and to what extent? And finally, we need also to clarify the distinction between permanent interventions and temporary ones. Thank you very much.
Thank you, Jean-Charles. Our second discussant is Philipp Schnabl from NYU.
Yeah, well, thanks a lot for having me here. Thanks a lot for the organizers to ask me to discuss this very interesting paper. Let me give you a short summary in my own words of what the paper is doing. So the paper is really asking the question, how did the ECB interventions during COVID-19 affect bond mutual funds? And it's sort of focusing on two mechanisms. The first one is looking at asset purchase programs. They have a very direct effect on bond funds because potentially going to raise the price of assets held by those funds. And the second one is sort of an indirect channel in the sense that the ECB in various ways provided liquidity to banks, as is usual in the crisis. And banks can turn around and channel that liquidity to those funds via providing repos to bond funds. Now, from an empirical perspective, the paper has sort of two main results. So result number one is a figure you kind of have seen already. It's my favorite figure in the paper. It's a very nice idea. They sort of take funds which have a high share of central bank eligible assets and compare it with funds with a low share of central bank eligible assets. And you kind of see the ones that have a high share, that's the solid blue line here, they outperform the low eligibility funds. Now, it's important to note that they converge pretty quickly. They're back to sort of being on the same line within a few months, and that's coming from the fact that the low eligibility funds often hold US securities, and the US security facilities were announced a bit later. But the sort of the ECB announcement effect, I think, is well identified here. And then the second result, and I would have liked to present the figure, it's kind of missing in the paper. This is sort of the table which speaks to it, is the idea that when the ECB provided liquidity to banks, it helped funds who did have a pre-existing relationship with their bank, which took out significant borrowing under the LTRO. So funds which have this relationship with an LTRO bank do receive more repo funding. So those are the kind of two main results. And the main takeaway is basically that the bond funds benefited in some sense directly and indirectly from ECB interventions. Sort of this underlying tone that the answer to sort of the question posed in the title of the paper is no, we don't need other facilities. The ones we have are enough. So my assessment is this is a very interesting paper, an important question. Paper is wonderful data. It's clear that a lot of work already went into it, and the empirical analysis is carefully done. And I think it's kind of like really important for understanding, central bank interventions during past crises, and obviously given the topic of this conference, future crises. Now, since I only have a few minutes, I decided to focus on one comment, and I think that's something they could do in the paper and they should do in the paper. They have to tell us more of how important are these two channels. Now, if I had time for a second comment, it would be very close to what Jean-Charles was talking about. I'm not quite sure whether we can say that they don't need access to the lender of last resort. I would have said slightly differently. In some sense, they already have access to the lender of last resort. And so I think there's a bigger question of why you want to intervene in those situations. Because clearly bond funds are benefiting of that, and then knowing that that will be the case, you would think it could be priced into securities, it's going to affect the liquidity. So the typical question about moral hazard will come up. And in fairness, you have a sort of section at the end which talks about that. And it sort of goes beyond the paper, but I think that's the other main thing to sort of think about. But in terms of the paper, let me give you my assessment on how I understand it from the paper on how important these things are. So what about the empirical identification? So as I mentioned before, we're just comparing funds depending on the share of central bank eligible assets. Now, just knowing that strategy, I would have been sort of concerned that maybe there could be differences in risk exposures. These funds could be very different. That's why they're performing differently. I'll bring up my favorite figure again. As Marie pointed out, this is very convincing. You see sort of the performance to being on top of each other until the announcement. When the announcement happens, they start to diverge exactly at the announcement. So I think the identification here is actually pretty clean. I would say it's also consistent with the work from the US. So there's a very nice paper which has now been published in the AR by Haddad, Moreira, and Maria, and they sort of look at what they call conditional policy promises. And the way I think about the mechanism in this paper is maybe similar in the US. They argued that these policy puts, so the idea that when you make the announcement, you're effectively committing yourself as a central bank to purchase assets when things get really worse, these policy puts explains a large share of the price impact. Now in the US, you didn't actually have to go out and buy much, the Federal almost nothing, but it does mean that there's a commitment and you might end up making these large purchases, so you're potentially taking on significant risks. So I think sort of connecting it a bit more with that mechanism, I think would be useful. Now in terms of magnitude, just sort of back of the envelope, the funds which had eligible assets, there were 46% of assets were eligible versus just 5% the others. And in the regressions, they estimate sort of a differential effect on the performance, 3.6%. So back of the envelope that suggests when assets became eligible, basically it increased the value of the asset by roughly 8.8%, almost 9%. So I would consider that large. That's pretty significant. Now compare that with the repo funding. So what's the idea between the repo funding? So here, you're going to compare funds effectively depending on their pre-existing, pre-COVID relationships. Now, there is sort of a well-established methodology in banking of doing that. The concern you do when you do that is always that, you're going to think about the relationships you're going to have down the line. If there's a crisis and you think you're going to have a lot of demand for funding, you probably want to sort of bank with those banks who are going to provide that. So in that setting, potentially that sort of proxy could really sort of signify that there's demand for loans, demand for repos. It's not the supply, as the paper wants to make it out. Now, what the authors are doing is sort of the quasi-Meehan methodology, looking within the fund across bank relationships. I think that part is actually very convincing. Now, you need a strong identification assumption when you aggregate up to the fund, but I think that's actually fine in this setting. Now, one issue I have, and you have seen this figure before, this is sort of total new repo lending to these bond funds. And in aggregate, I think it's hard to make that case that this really matters. So if anything, it looks like that relative to sort of the pre-COVID period, the repo funding to these bond funds dropped. Now, presumably without bank liquidity support, it might have dropped even more, but it wasn't that large to begin with, and it actually got smaller. It sort of piped up after the bridge LTROs, but it's still less than before. So there's a bit of sort of a missing intercept problem, thinking about the aggregate effect. So some of it may just be sort of redistributing sort of funds towards banks who happen to have these relationships. Now, if you look at the economic magnitude, sort of separate from the identification, I think there's also sort of a bit of an issue. I couldn't quite find in the paper, but my understanding from looking sort of aggregate numbers is, and I think Marie mentioned those in the presentation, is relatively small. It's something on the order of 3% of total fund assets pre-COVID, and only sort of a limited number of funds actually borrow in the repo market. And there's actually a limit, and I think Marie mentioned as well, they mentioned in the paper, you can never borrow more than 10%. And the regressions, at least as far as I understand them, having a better relationship increases repo funding by a relatively small amount, 26 basis points. There's a large effect on fund performance, but I think timing of that is not quite clear because I think it should come at the announcement, given I think that this information is known, but it only comes actually when it's being implemented, so I wasn't quite sure how to interpret that. Now, basically what that means, or the way I read it, is the asset purchases had a really economically large effect. And as I mentioned before, I think we really want to understand better whether that's the right thing to do, what's the potential moral hazard associated with that. I think the repo funding was sort of second order. Now, I don't think that's a problem for the paper at all. I think it's just as important to know what works relative to what doesn't work. So in some sense, I would just like to know what's the author's stance. If they agree, well, then maybe sort of, make that clear that it doesn't work, or, if I'm wrong, then maybe make it clear on why it would be important. Now, one important thing is, if you had asked me before reading the paper of what's going to be the impact of ECB banking liquidity, I wouldn't have thought about repos. I would have thought about, well, in crisis, we know that bank balance sheets typically blow up. Why? Because too big to fail bank's going to get deposits, and they have access to the lender of last resort. So what do? They go out and often purchase assets. So I would have thought that would be sort of the first order effect. Now, they actually look at this. There's a footnote, and they say we don't have perfect data. But I think that's actually very useful. They think that's not the case. So maybe a little bit more analysis on that would be helpful. But I think that would be the other channel you may have in mind. So with that, let me conclude. I think it's a very interesting paper. I think the asset purchases are clearly first order. We understand those better. Repo funding, to me at least, in second order. I would like them to quantify it more. I think this paper is highly recommended for anybody interested in understanding central bank interventions. Thank you.
Thanks, Philipp. Let's open up for Q&A, and Marie, you can then, while you're answering questions, maybe also address what the discussants raised. So I got to remind the participants to stand up and ask the questions using the microphone. If there are no questions, oh, there is, okay. Could we have a microphone here?
So Pierre-Olivier Gourancha from the IMF. Thought the paper was very interesting. On the first part, on the asset purchase, there is a part that is kind of mechanical, right? The ECB is announcing that it's going to purchase asset A, fund 1 as assets A in its balance sheet. Everyone expects asset A's price to go up. The fund performance is going to be higher than fund number 2, which doesn't have asset A. But then there's part of me that's thinking, you're measuring only a different effect. And so I'd like to see the fund flows. You're not showing us the fund flows. Do I see that there is less outflows from fund 1 relative to fund 2? It could be that just I look at fund 2 and I see it doesn't have assets that are purchased by the ECB. I want to move out, and the performance of that fund goes in a tank. The other one does better, but it's all relative, and they're still doing pretty poorly. So I think there's the intercept effect, and I'd like to see the fund flows as well. On the second, the provision of liquidity through the banks, I'm with Philipp here that it seems very indirect. If we want to rely on this to provide support to the funds, there are all kinds of reasons it could not work. You could imagine that the banks are not going to be channeling the liquidity they get from the TLTRO to the funds. Maybe they will buy sovereign bonds. And there are earlier episodes of liquidity provision where that is exactly what happened, and you would be concerned about whether the liquidity ends up in the right place. So it leaves me in a little bit of an uncomfortable position in concluding with you, oh, we have the right instruments, it's all fine. At the same time, I think that I'm also uncomfortable if I think that we have to do more, if central banks have to do more for non-bank financial institutions. So, thanks.
No, thanks so much, Pierre-Olivier, and many thanks to Jean-Charles and Philipp for a really fantastic discussion. So let me maybe start with Pierre-Olivier, but it touches upon some of the things that also Jean-Charles and Philipp brought up. So on the flows, that's actually the variable we care about, right? Because I motivated everything with runs, and we really care whether somehow what the central banks did manage to actually stop the run, right? And I showed it not in the form of this very nice figure, although I think we can also produce a nice figure on that. I showed it in the form of a table, our result. So what I showed is with PEP announcement, there were continuous outflows in the group of funds that had lower PEP eligible assets, daily outflows on average of minus 0.5% of TNA. So these are very high outflows. You think in 2 days it's 1% of your TNA. In a week it's 2.5%. So it's very large outflows. And we show that the group of funds that had more PEP eligible assets only had outflows of minus 0.2%. So that's the differential of 0.3 percentage points that we showed. So that's, I would say, a large difference. Also, if you take minus 0.5 as the base and you take 0.2 as the outflow, it's 63% increase in net flows. That's a very large effect, I would argue, on the flows. So, and again, it's maybe not terribly surprising once PEP improved performance, which you say, arguably is mechanical for those that have a lot of PEP eligible assets. This is what we would expect. The flows should also improve, right? We know that bad performance triggers outflows. Here, performance improved, outflows should also improve. And we do see that, and quite strongly. So this would be my take on this. On the bank channel, so actually going into this, it was, I think our prior was similar to yours, which is to say, okay, we know banks have access to lender of last resort. Of course, in the world without frictions, they might pass on this liquidity to the rest of the financial system, but we do not live in the world without frictions, right? And we know that there are many reasons why banks might not pass on that liquidity. I mean, there was work done also by Johannes and Victoria on leverage ratio and so on. So now we argue with the repo lending. Maybe leverage ratio is a bit less binding because repo lending doesn't really increase your leverage. Repo borrowing does, but to the extent that banks want to run a matched repo book, maybe that also factors in. So there are lots of market power, lots of frictions that might prevent a smooth passing on of central bank liquidity to other parts of the financial system. This was our prior, and we wanted to see what happens in the data. To our surprise, we actually did see that this, if you will, bank lending channel of channeling central bank liquidity to non-banks is there. Now that brings me to Philipp's point, is it large and can we fully rely on it? To be frank, it is not large, it seems to us. And for me, the two key points, it's not that it is not so large in terms of what banks pass on. Actually, I think our coefficients are reasonably large, but it's more the extent to which funds use this market. They use it very little. I don't have an answer why that is the case, but they do not rely heavily on repo borrowing in the euro area. I do not know the data in other jurisdictions. So, kind of coming back to, I think Nicola mentioned this morning, sort of liquidity insurance, right? So one way to think about this bank repo lending to funds is like, this is their lifeline to the lender of last resort, right? The indirect lender of last resort access. And, do many funds have this line? Not in the repo market. About 5% of bond funds, we estimate, have this line, but others not. Plus, there is this limit on leverage that we already mentioned. And was it binding? I mean, we find that I think about a quarter of our funds actually faced outflows of more than 10%. So they would hit that leverage limit quite quickly in this very severe crisis. Maybe I'll come back to one of the points of Jean-Charles, which is to say, what kind of intervention was it? What drove? What was the underlying friction? What was the purpose? I mean, to me, the purpose was clear, was to respond to a turmoil triggered by an exogenous event, a pandemic. This was an aggregate liquidity shock. This is a circumstance where central banks should intervene. It's the only agent in the economy that is not subject to liquidity constraints. Now, I think the ECB was clear that the PEP in particular had a dual role. One was the market stabilization role, and that is very clearly what we have focused on in the paper. But there was also this other role, which is to deliver monetary accommodation in the zero lower bound, and this was basically for price stability. We haven't looked at this in this paper, so I want to stay away from that. But there is, of course, I think one important aspect, and this touches also on Raghu's keynote. To me, mopping up after every crisis in an ad hoc way does create the expectations that central bank is always there. And I think it does raise moral hazard concerns. So to me, a useful distinction is between discretionary ex post interventions and more rule-based arrangements. And if I think about asset purchases in response to exogenous aggregate liquidity shock, pandemic, 9/11, terrible events, and the central bank has a predefined list of eligible assets it buys, if anything, the funds should be thinking, okay, I want to get that liquidity insurance from the market maker of last resort in the case of an aggregate liquidity crisis. I should hold these type of assets. And those are liquid assets in normal times, kind of in line with the Badger-Hodge principle. And so to me, the specter of moral hazard is highly diminished here. Because if anything, we're encouraging them to hold more liquid assets rather than the moral hazard I typically think about is loading up on illiquid, very risky assets. Okay? Because we clearly showed that it was the funds that actually do have those highly liquid in normal times assets that benefited from the PEP.
Well, thanks, Alessio De Vincenzo, Banca d'Italia. Thanks a lot for the presentation. Just following up on your last point on the risk exposures, I was wondering whether you had the possibility to check, let's say, or to verify whether there's a difference between the two types of funds exposed in their risk exposures attitude. I'm just mentioning this because there is work done at the bank by a couple of colleagues, actually, that found that both for European funds and US funds that had exposures to assets, part of the eligible assets under the PEP program, and they actually found that in the risk exposure or risk-taking attitude there was a difference. So the ones that were exposed, the higher share of liquid assets, actually their composition of the portfolio changed a little bit after this intervention, maybe over an horizon that is longer than the horizons that you have taken into account, but in a way the risk attitude changed a little bit, increased with respect to the other category of funds. So I guess, whether this might be useful also in terms of the overall debate, whether or not this support that this indirectly obtained from this intervention has to be somehow part of a discussion of a reform or a review of the regulation on these funds. Thanks.
No, thanks a lot. We haven't looked at it explicitly on the ex post performance. We could. And indeed, it's an interesting question. Again, if investors value that liquidity insurance from the market maker of last resort, if anything, one would expect that funds might want to invest more in this type of assets, ceteris paribus. So, but this is something that we can investigate if there is actually some realization on the part of the funds that this is actually a valuable liquidity insurance. Of course, presumably these assets have a lower yield in normal times, so there is a trade-off. But that's what insurance is about.
Thank you. Enrico Perotti, University of Amsterdam, still the same. So I worked on bank runs, and I think I'm particularly interested in the question of what creates an escalation. So the March 2020 was a time where there was legitimate demand for liquidity, which pulled a lot of money out of funds, even more in the US. That was completely legitimate. And then there was, of course, escalation potentially, and certainly, interestingly, bond funds are the one where you have a bank run type of concern that if everyone is running on your fund, and these are illiquid assets, like banks, not like money market fund, even stock funds are not as illiquid, that you want to be out quickly. So what I think would be very interesting is to try to separate the direct impact and the indirect impact. I mean, what I find striking is that the impact you see is there even before you start to have purchases. So it's the announcement effect. So the key, if we want to contain outflows from funds that are self-fulfilling, is to discourage the process of escalation where people that need liquidity get it, and everyone else doesn't start to think, what is everyone else going to do? And in the US, since 2023, there are, for specific fund, institutional funds, mandatory charges, redemption charges, which are triggered automatically upon very large outflows. And that's exactly the kind of sand in the wheel that stops the self-fulfilling component. There is a similar legislation proposed in Europe. I'm not sure if it applies to bond funds. But, okay, aside from this aside, I have a sense that you have measurement or quantity both, and you can actually separate how much is the announcement effect, the quantity effect, and I think that would be interesting. Thank you.
No, thanks a lot, Enrico, for this question. So, I mean, you're right. The old style runs in the fund sector. I mean, Itai Goldstein has written on this already, I think, in 2010, right? I think the president alluded to it in her speech, right? There are always the same ingredients that lead to runs, right? It's a liquidity, it's fire sales, it's multiplicity of equilibria, right? Which is sort of the ingredients that feed into the fragility in funds, or in bond funds in particular, and sort of there are these front-running incentives, and it is linked to the liquidity of assets, the fire sales, but also the fact that the fund promises a fixed value to the investor, which is the value of the fund at the end of the day, whereas liquidation actually typically takes several days. So those who get out early get out at a better price, and so this creates these front-running incentives. Now, you mentioned something very important, which is that, shouldn't we also, I mean, the way I interpret your question is that shouldn't we also think about what leads to runs and tackle those issues? And so there are proposals indeed of swing pricing, which would tackle something like this. Let me just mention maybe two things in the European context. Swing pricing was actually allowed in Europe already before COVID. What is interesting, it was in the discretion of the fund whether to impose it or not, and funds actually chose by and large not to impose it. And I think there is an interesting coordination problem there, and perhaps it should be imposed by somebody else just than the fund itself. You also mentioned there were large outflows in the US, even larger than in Europe. I would put it a bit differently. In absolute terms, in euros or dollars, the outflows were actually very similar in both Europe and the US. But the fund sector in Europe is actually quite a bit smaller. So in relative terms, there were a huge run in Europe, enormous. And we have looked in another work on actually who was withdrawing money from the European funds. We looked at the liability side, and what we did is we even looked within the same fund and day, so holding the asset side fixed. So you talked about risk, but here we're holding the risk and liquidity, everything constant. And so what we found is it was not households who were running on funds, but actually a particular segment of institutional investors, and often also entities outside the euro area. So there was if you will, fragility in funds is linked to this liquidity provision. And I think the point is, whom is this liquidity provided to? Is it households or is it somebody else? We find that it is often somebody else. And there is some free riding on this liquidity provision by foreign investors and sophisticated investors. And I think that's something very, very worthy thinking about, how we deal with these issues. Thank you.
One last question.
So Paola Sapienza, Hoover Institution. Following up on this and what Pierre-Olivier said before, there are costs of this. I mean, I understand that you're comparing, a more draconian intervention to the least draconian, and you say this is enough. So, that could be. But there are really big costs in running these, which doesn't seem to appear in the presentation. And, some of this is distributional, which is what you're touching upon. So to what extent this was needed in the first place. You say, well, there is an effect. A part of the effect is mechanical, but also, and of course, the counterfactual, I think this is an unfair question in some way because we don't know the counterfactual, we don't know what would have happened and so on. But I'm wondering if there is a way you're thinking about, evaluating the cost of intervening at all, because there is, and this goes back also to, one of the discussants, just what's the objective here? Who are we sheltering from? And, the fact that you mentioned that there are distributional factor just enhances my interest in this question.
Again, excellent question. So I think this calls for a good model. Also so that we can understand normative implications and compare policies and so on and so forth. Here we took I think a very pragmatic approach, meaning we said, look, even the most liquid markets, treasury markets, bond markets in Europe are in turmoil. There is no way the central bank is not going to intervene. It's just inconsistent to say anything else, and it did. And let's see whether in these interventions, as well as these indirect interventions in terms of providing liquidity to banks, does it trickle down to non-banks that have no lender of last resort access, right? And we just wanted to trace these channels. But I think the broader question of the relative importance of interventions is also the point that Philipp brought in, and the costs and benefits. We mostly looked here at the benefits and some of the caveats to the propagation mechanism, like the repos are not widely used, etc. But I think you are spot on. We have not really explicitly considered what are the costs of different intervention. And so in a full-fledged analysis of, should there be access, should not be access, this should definitely feature. This is not a normative paper. This is just to say, you know what? We are hearing also from our operational colleagues, it's very hard to think how to set up the framework of giving access to this extremely heterogeneous and a huge NBFI sector. Let's take a first step. We have tools. Do they actually have a way to reach the non-banks? And the answer is yes. And when it comes to purchases, it reaches them quickly and stops runs very fast.
All right. Thank you, Marie. Thank you, Jean-Charles. Thank you, Philipp.